You ever watch the stock market start to absolutely tank and just think to yourself, is there an emergency brake for this thing? Well, turns out there is. Today, we're going to dive into trading halts and circuit breakers, the systems designed to pull the entire market back from the brink of total panic. So, picture this. Some really bad news hits, and bam, everybody starts selling at once. Prices just plummet, not based on any kind of smart analysis, but on pure, raw fear. It's like a digital stampede that can literally wipe out fortunes in minutes. So, how in the world do you stop the bleeding? Well, you can't exactly stop the fear itself, but you can stop the trading. See, regulators have this really powerful tool. They can just pause everything. It's not about controlling where prices should be. It's about controlling the chaos and giving everyone a second to just breathe. Now, to really get why these breaks even exist, we've got to go back in time to one of the most notorious days in the history of the stock market. The year is 1987. The day is Black Monday. The market started to fall, which, caused traders to panic and sell more, which then pushed prices down even further, which, you guessed it, caused even more panic. It was this absolutely vicious cycle. And after all that chaos, the New York Stock Exchange realized, okay, we need a way to break this loop. Now, you don't see these halts happen every day, but they have been used during some of the most critical moments we've ever faced. We're talking 9/11, the 2008 financial crisis, and yeah, most recently, during all that uncertainty at the very beginning of the COVID-19 pandemic. So, how does this emergency brake actually work? It's not just some big red button someone slams. Oh no, it's a pretty sophisticated, multi-level system. At its heart, a circuit breaker is just an automatic timeout on trading. And the goal is super simple. Hit the pause button on all the panic selling, give investors a moment to actually process what's going on, and maybe, just maybe, let some buyers step in and bring a little order back to the madness. Okay, so check this out. It's basically a three-level defense system, and it's all tied to the S&P 500. If the market drops 7%, bam, level 1 halt. That's a 15-minute timeout for everyone. If things keep getting worse and it hits a 13% drop, that triggers another 15-minute pause. But if we hit a 20% decline, that's level 3. It's game over. Trading just stops for the rest of the day. All right, so that's the whole market. But what happens if it's just one single stock going completely haywire, even when the rest of the market is, totally fine? Well, there's a system for that too. It's called limit up, limit down, or LULD for short. The easiest way to think about it is like a personal circuit breaker for an individual stock. It creates this kind of price corridor around where the stock has been trading. And if the stock price tries to jump outside that corridor for more than 15 seconds, boom, trading gets paused for 5 minutes. And you can see right here how those price bands work. For the big, stable, Tier 1 stocks, think S&P 500 companies, that band is a pretty tight plus or minus 5%. But for smaller stocks or those really low-priced penny stocks, the bands get way, way wider to allow for a little more natural movement. It's a really smart, tailored approach to stop chaos before it starts. Okay, so we've got all these complicated systems in place. But the million-dollar question is, do they actually work? And this, my friends, is where the debate really starts to heat up. On one side of the ring, you have people who say these halts are absolutely crucial for stability. They give the market a chance to breathe, digest the news, and stop irrational selling. But on the other side, the opponents argue, hey, you're just delaying the inevitable. They say these pauses mess with the market's natural ability to figure out a stock's true price. And sometimes they can even make the volatility worse when trading starts back up. So what does the actual data tell us? Well, a really interesting study from Singapore Management University looked at this, and they found some strong evidence that, these halts are a good thing. They concluded that halts actually improve how efficient the market is. They help get information out to everyone equally, and that after a pause, things usually get back to normal pretty quickly. But of course, it's not quite that simple. The researchers found a really important little detail. How long the pause lasts really, really matters. Get this. It turns out that a short pause is helpful, but a really long one can totally backfire. These extended halts can actually create more uncertainty and lead to even crazier price swings when the market reopens. So there's a sweet spot, a brief timeout, not a long shutdown. So we've talked about the market as a whole, but what about the actual people doing the trading? People like you and me. How do these halts affect us? The answer is probably not what you're thinking. When a stock gets halted and then trading reopens, who do you think rushes back in first? The big Wall Street institutions, right? Nope, not even close. The same study found that individual, everyday retail investors account for a staggering 85% of the trading volume right around these halts. They absolutely dominate this little corner of the market. And here is the absolute kicker. You would probably assume these retail traders are getting crushed in all the chaos, right? Well, the study found the exact opposite. On average, they consistently get better prices than the big institutional and foreign investors. They aren't the victims here. They're actually winning. So how are they pulling this off? It's actually pretty brilliant in its simplicity. They follow that classic contrarian playbook. When everyone else is panicking and selling, they're buying low. And when there's good news after a halt, they're selling high into all that new excitement. They're using the pause to their advantage and trading against the herd. So when you step back and you look at the whole big picture, what's the point of all these rules and all these pauses? What are they really for? It really all comes down to one thing: creating a little bit of breathing room right in the middle of a storm. It's a short window to step away from all the flashing red numbers on the screen and actually think instead of just reacting. It's an attempt, a really important attempt, to inject a dose of rationality right when raw emotion is threatening to take over the driver's seat. The hope is that when trading starts again, cooler heads are going to prevail. But that does leave us with one final big question. These systems, they're designed to manage the mechanics of the market, but a real panic, that's a force of human psychology. And you have to wonder, can a 15-minute timeout really be enough to conquer something as powerful as our own fear? That's definitely something to think about.